U.S. consumer price inflation was surprisingly soft in November, with an annual headline rate of just 2.7%. There is more skepticism due to the scale of the downward miss relative to analyst expectations and the impact of the record longest government shutdown. But the inflation report was remarkably soft, given the backdrop of tariffs and concerns over insurance costs. The softer reading levels leaves the door wide open for earlier and swifter 2026 rate cuts. That also explains why Fed Chair Jerome Powell sounded so relaxed last week. However, the Fed boss suggested the tariff impact will peak in the March quarter of 2026. Still, the market views is for a rate cut in March and another in June. But the risk seemed skewed towards a Fed being able to deliver more. Unless the job market starts to stabilize, the latest jobs data and the surge in bond yields suggest otherwise. While anecdotal reports showed Americans are feeling the pinch of rising prices of daily goods to almost everything, hard inflation data is yet to catch up. Across the Atlantic, the European Central Bank rates kept on hold. The central bank's new forecast shows the good place is the right place. ECB President Christine Lagarde reiterated that the central bank was in no rush to change rates anytime soon. But the ECB revised its 2026 inflation forecast higher. On the other hand, the Bank of England cuts rate in a highly divided decision, but the decision was more hawkish than expected, leaving market rates higher and sterling slightly stronger. Bets show that it's a close call whether the banks cut again in February or March, but investors say the UK will soon look less of an inflation outlier, giving it room to cut in the second half of 2026. Now, the real question for the developed economies in 2026 is, how far and long will the current rate cut cycle run, and what happens to inflation next year when tariffs start to reflect in official figures? More importantly, can central banks, especially the Fed, look past inflation to fight an economic slowdown and the real impact of President Trump's trade brinksmanship? And for more on this, our correspondent Susan Tehrani has sent us this report from New York. Take a look.
For Americans watching inflation, the latest takeaway is this. Prices are rising more slowly than expected, at least for now. November's inflation data came in softer than forecast, even with tariffs and higher insurance costs looming. This gives the Federal Reserve more breathing room and keeps rate cuts firmly on the table. Markets are now betting that the Fed could start cutting rates as early as March, with another possible move by mid-year. Good news for borrowers, mortgage rates, and financial markets. But there's a catch. Many households still feel squeezed at the grocery store and gas pump. Economists say that pain hasn't fully shown up in the official data yet, and tariffs could start pushing prices higher in early 2026. Overseas, central banks are sending mixed signals. Bottom line, relief may be coming, but the inflation story isn't over, and 2026 could be the real test. Susan Tehrani reporting from New York for WION World is One.